In 18 months, the United States will face its Ottoman moment. We're at stage 5 of a 7-stage liquidation sequence the empire pioneered in 1875. Here's why your retirement account is the collateral. The Ottoman Empire's 1875 default declaration sat on a mahogany desk in Istanbul's Ministry of Finance. Debt to GDP, 110%. Annual deficit, 40% of revenue. Foreign creditors held £200 million in bonds they believed were sovereign guarantees. Within 6 years, European powers controlled 30% of Ottoman tax revenue through the Public Debt Administration, history's first external creditor control board. The empire lost 83% of its territory over the next 40 years, liquidating assets to service debt it could never repay. Today, America's debt to GDP sits at 123%. Foreign creditors hold $7.2 trillion. The question isn't whether this pattern repeats. It's whether anyone notices the Treasury auction failures before mortgage rates hit double digits. This is stage 1 of the liquidation sequence, the vendor financing bubble. Here's why this matters to you. Your iPhone costs $400 less than it should. That $400 discount is a loan from China you'll repay with interest in devalued dollars and lost jobs. The United States ran a $5 trillion cumulative trade deficit from 1995 to 2008, funded entirely by foreign central banks buying Treasury bonds they didn't want, at yields that didn't compensate for risk. Picture the People's Bank of China trading desk, Beijing, 2005. A room of analysts watching container ships leave Shenzhen loaded with electronics bound for Walmart. Now, each ship generates $500 million in dollar receipts. The dollars pile up. There's only one market liquid enough to absorb them, U.S. Treasuries. They buy $300 billion that year. Not because Treasuries are attractive, because there's no alternative. This is vendor financing, forced lending, to your customers so they can keep buying. China exports $2 trillion in goods to the U.S. from 2000 to 2008. Receives $2 trillion in paper. Those dollars are liabilities on the Fed's balance sheet, claims on future U.S. production. But the U.S. isn't producing enough to redeem those claims, so China loans the dollars back by buying treasuries. The loan funds America's trade deficit, which enables more Chinese exports, which generates more dollar receipts, which require more treasury purchases. It's a self-reinforcing loop, just until the borrower can't service the debt. Here's what this means for you. From 1995 to 2008, real wages stagnated while consumption soared. The gap was filled by cheap imports, clothing 30% cheaper, electronics 50% cheaper, toys 40% cheaper. You live 20% better than your productivity justified. The bill is coming due. When foreign creditors stop rolling over treasuries, import prices spike 40% overnight. Your $400 iPhone becomes a $700 iPhone. Your $30 Walmart cart becomes a $50 cart. And there's no wage growth to offset it. Manufacturing never rebuilt. This creates the deindustrialization spiral. Cheap imports kill domestic manufacturers. Factory closures destroy the middle-class wage base. Service jobs replace manufacturing, lower pay, fewer benefits. Tax revenue declines. And deficits widen, treasury issuance increases. More foreign lending required. The Rust Belt isn't a policy failure, it's the collateral cost of vendor financing. The Ottoman Empire did this with agricultural imports from Egypt. When the debt collapsed, famine followed. You might be thinking, this is just free trade working. We get cheap goods, they get dollars. Everyone wins. Here's the problem with that assumption. It only works if the borrower can repay. The Ottoman Empire thought European loans financed modernization that would generate growth to service debt. Instead, debt service consumed revenue that should have funded productive investment. The U.S. spent vendor financing proceeds on consumption, imports, and military overhead. Bases, not productivity-enhancing capital. When China's $1.3 trillion in treasury holdings comes due, what does the U.S. export to repay them? The trade deficit hasn't closed, it widened to $800 billion annually. The loan was never sustainable, and that's just stage 1, the setup. Stage 2 is where interest rates expose the fraud. We've entered stage 2, the interest rate shock that exposes unsustainable debt loads. Here's why this matters to you. When the Fed raised rates from 0% to 5.5% in 18 months, Your mortgage payment jumped $600 per month, and your retirement account lost 40%. That's not a bug, it's the margin call revealing who's swimming naked. The U.S. Treasury now pays over $1 trillion annually in net interest. That's 17% of federal revenue going to creditors before a single government service is funded. Picture the Treasury Department's Office of Debt Management, January 2024. And then they're staring at a $9 trillion refinancing schedule over the next 3 years. Average maturity of outstanding debt, 6.2 years. Problem: when those bonds were issued, 2015 to 2020, the 10-year yield was 2%. Now it's 4.5%. That's not a 2.5% increase, it's a 125% increase in borrowing costs. The math doesn't work. This is the debt service spiral. When rates rise, two things happen simultaneously. First, new borrowing costs spike. A $2 trillion deficit at 2% rates costs $40 billion annually. At 5% rates, it costs $100 billion, $60 billion more without any increase in spending. Second, maturing debt must be refinanced at higher rates. The Treasury issued $8 trillion in bonds from 2008 to 2015 at average yields under 2%. Those bonds mature 2025 to 2030. They'll refinance at 4 to 5%, doubling the interest cost on existing debt. The Ottoman Empire faced this in 1873. Old bonds at 4% maturing, new bonds requiring 12% to find buyers. Within 2 years, debt service consumed more than total tax revenue. Here's what this means for you. Every 1% rise in Treasury yields adds $360 billion to annual debt service within 3 years as bonds roll over. That's $2,700 per U.S. household. Where does that money come from? 3 places: higher taxes, spending cuts, or inflation, printing money to pay creditors. The 2022 to 2024 rate hikes added $400 billion in annual interest costs. Your taxes didn't go up yet. The Fed printed money to buy treasuries, quantitative easing. That's stealth taxation via inflation. Your grocery bill is up 25%, and as gas is up 30%, insurance is up 40%. That's not corporate greed, it's the hidden cost of unsustainable debt meeting higher rates. Higher interest costs create fiscal crowding out. If debt service is $1 trillion, that's $1 trillion not available for infrastructure, defense, entitlements. The political response is always the same: cut discretionary spending, raise revenue through inflation, and hope interest rates fall. But rates don't fall because creditors see the unsustainable trajectory and demand higher yields for risk. The Ottoman Empire tried to finesse this with temporary tax increases that became permanent. Social unrest followed, provinces rebelled, the empire fragmented. When debt service exceeds 20% of revenue, political legitimacy fractures. You might be thinking, the Fed can just lower rates again. Problem solved. Here's the problem. The Fed only controls the overnight rate. The market controls long-term rates. When the Fed cuts to zero, if creditors see unsustainable debt, they demand 6% or more on 10-year bonds anyway. This is the yield curve inversion that precedes crises. The Ottoman Empire's creditors demanded 12 to 15%, even as the empire slashed spending and raised taxes. Why? Because lenders saw default risk. The U.S. faces the same dynamic. Foreign creditors holding $7.2 trillion in treasuries see debt to GDP at 123%. Deficits structural, not cyclical, and no political will to cut spending. They're not lending at 2% anymore. The 10-year yield bottomed at 0.5% in 2020. It's now 4.5%. That's a 900% increase, and we're only at stage 2. That was the margin call. And stage 3 is when creditors actually walk away. This is stage 3, foreign treasury liquidation. Here's why this matters to you. When China, Japan, and Saudi Arabia reduce their treasury holdings by another $500 billion, the Fed has to print money to fill the gap. That printing destroys your savings. The dollar loses 30% of its value against other currencies over 18 months. Gas hits $7 per gallon. Imported goods cost 40% more. Your savings lose half their purchasing power. Foreign central banks held a peak of $7.7 trillion in U.S. treasuries in 2021. Today, that number is $7.2 trillion, down $500 billion. China alone reduced holdings by $300 billion. This is the margin call in action. Creditors exiting before forced restructuring. Picture a central bank trading floor in Riyadh, March 2025. Saudi Arabia's sovereign wealth fund manages $900 billion in assets. $200 billion sits in U.S. Treasuries. The portfolio manager pulls up a screen showing 10-year yields at 4.5%, inflation at 3.5%, real yield 1%, but the dollar is depreciating 5% annually against the Saudi Riyal basket. Net return, negative 4%. They're losing money holding U.S. debt. The instruction comes down: reduce Treasury exposure by $50 billion this quarter. Shift to gold, commodities, infrastructure. The liquidation has begun. This is the vendor financing collapse. For 30 years, foreign central banks recycled trade surplus dollars into treasuries automatically. It was the only market deep enough, liquid enough, to absorb hundreds of billions quarterly. But that recycling isn't automatic anymore. Why? 3 reasons. First, sanctions weaponization showed them dollar reserves can be frozen. Russia lost access to $300 billion overnight in 2022. Second, negative real yields make treasuries a guaranteed loss after inflation and currency depreciation. Third, alternative payment rails are operational. BRICS nations built the CIPS system, processing $80 billion daily in non-dollar settlements. They have optionality now. Here's what this means for you. When foreign demand for treasuries drops, someone has to buy the bonds the treasury issues to fund deficits. There are only 2 buyers of last resort: primary dealer banks and the Federal Reserve. Primary dealers, 24 major banks, are required to bid at treasury auctions. But they can't absorb $500 billion in reduced foreign demand without massively expanding their balance sheets. That creates systemic risk. So the Fed steps in. Quantitative easing. The Fed buys treasuries with newly created money. From 2008 to 2022, the Fed's balance sheet went from $800 billion to $9 trillion. They bought $5 trillion in treasuries. That's monetization, printing money to fund the government. And it causes inflation. The second order effect is currency debasement. When the Fed prints $5 trillion, each existing dollar is worth less. It's dilution. Your savings account, your paycheck, your retirement fund, all denominated in dollars. When the supply increases 40%, purchasing power falls proportionally. This is why gas costs $4.50 now instead of $2 in 2020. Why groceries cost 25% more. Why your rent went up 30%. The Fed monetized debt to cover the foreign creditor exit. You paid for it in devalued purchasing power. The Ottoman Empire did this in 1876. They debased the currency 50% in 2 years, trying to inflate away debt. It triggered hyperinflation and social collapse. Now we have to address the elephant in the room. What if foreign creditors coordinate the exit? If China, Japan, and the Gulf states simultaneously dump $1 trillion in treasuries, the Fed can't absorb it without triggering a currency crisis. The dollar would collapse 40% in months. Import costs would double. Supply chains would freeze because dollars wouldn't be accepted for payment. This is the coordination risk that keeps Treasury officials awake. You might be thinking, foreign creditors can't dump treasuries. They'd lose too much money crashing the market. Here's the problem. They lose more by holding. If you know a bond will be restructured, you sell before the haircut. The Ottoman Empire's creditors who exited in 1874 before the 1875 default got par value. Those who stayed took 50% losses. Foreign central banks are exiting now while liquidity exists. When the exit becomes a stampede, there won't be buyers at any price. The Treasury market will freeze like mortgage-backed securities did in 2008. We've completed 3 of 7 stages. Stage 4 is where external control begins. This is Stage 4, the IMF rescue with covenants. Here's why this matters to you. When the U.S. can't sell enough treasuries to fund the deficit, the International Monetary Fund steps in with bridge financing. But that financing comes with conditions. Social Security benefits cut 25%. Medicare eligibility age rises to 70. Unemployment hits 12%. This is the Ottoman Public Debt Administration playbook, external creditors controlling your budget. The IMF manages $1 trillion in lending capacity. When a nation can't finance itself, the IMF provides emergency loans in exchange for fiscal reforms. Britain in 1976. Mexico in 1982, Argentina in 2001, Greece in 2010. The terms are always the same: cut spending, raise taxes, privatize assets. Picture an IMF negotiating room, Washington, D.C., 2027. U.S. Treasury officials sit across from IMF staff. The proposal: $500 billion in emergency financing. The conditions: reduce the deficit from $2 trillion to $1 trillion within 4 years. Social Security, $1.4 trillion annually. Medicare, $1 trillion. Defense, $850 billion. Everything is on the table. The IMF presents the term sheet. Okay, it includes an independent fiscal oversight board with veto power over the federal budget. This is what external control looks like. This is the covenant trap. IMF loans aren't charity, they're leverage. The loan comes with policy conditionality. If you violate terms, the loan gets called. Credit ratings collapse. Private creditors flee. So you comply. You cut pensions, raise retirement ages, sell state assets. The Ottoman Empire signed this deal in December 1881. The Ottoman Public Debt Administration, controlled by 6 European powers, took direct control of 30% of tax revenue. Tobacco taxes, salt taxes, stamp duties, all collected by European bureaucrats and used to pay European creditors. The empire lost fiscal sovereignty for 40 years. Here's what this means for you. The deficit is $2 trillion structural. Tax revenue is $4.9 trillion. Spending is $6.9 trillion. That's a 40% gap. It can't be closed without massive tax increases or entitlement cuts. Politically, neither is possible. So the deficit continues until creditors force the issue. When Treasury auctions fail, when the Fed can't monetize more without sparking runaway inflation, when the IMF becomes the only option, you lose control. Your benefits get cut by unelected technocrats accountable to creditors, not voters. The second-order effect is political fracturing. When living standards collapse, legitimacy erodes. The Ottoman Empire saw this in the 1870s and 1880s. Provinces that paid taxes but received no services rebelled. Bulgaria, Serbia, Greece, Romania all broke away. The U.S. faces the same dynamic. If Social Security gets cut 25%, if infrastructure crumbles, now states will question why they send tax revenue to Washington. Let me be completely clear, this isn't hypothetical. The IMF used this framework with Britain in 1976. The UK had run deficits of 9% of GDP. Sterling collapsed 30%. The UK went to the IMF for $3.9 billion. The IMF demanded cut spending, raise interest rates, sell state assets. The Labour government complied. It destroyed them politically, but it stabilized the currency. You might be thinking, the US controls the IMF. We have veto power. We'd never accept those terms. Here's the problem. When you're insolvent, you don't have leverage. If China, the EU, and Japan coordinate, they can impose terms. And even if the US vetoes IMF involvement, the market imposes austerity anyway. If Treasury yields spike to 8%, the deficit becomes unfundable. The government either cuts spending 40% immediately or defaults. IMF conditionality gives you a structured timeline. The alternative is disorderly collapse like Argentina in 2001. The peso lost 70% of its value in months. Banks froze deposits. 20% unemployment. That's the cost of refusing external restructuring. We've completed 4 of 7 stages. Stage 5 is the asset liquidation. This is Stage 5, asset liquidation. Here's why this matters to you. When the government can't service debt through tax revenue, it sells assets. China owns California ports. Saudi sovereign funds own Texas oil fields. Foreign toll roads appear nationwide. Your infrastructure gets sold to pay creditors. The U.S. federal government owns assets worth an estimated $5 trillion. 640 million acres of land. 8,133 tons of gold in Fort Knox. Saw the Strategic Petroleum Reserve, port infrastructure, 750 overseas military bases. When debt becomes unsustainable, these assets get liquidated. Picture a Treasury Asset Sales Office, 2029. A team evaluates which federal assets can be sold to raise $2 trillion. Strategic Petroleum Reserve. 371 million barrels at $75 per barrel. That's $28 billion. Gold reserves, 8,133 tons at $2,500 per ounce. $650 billion. Port leases, Los Angeles, Long Beach, New York, worth $200 billion in concession rights. Federal land mineral rights, $3 trillion estimated value. Sell $2 trillion in assets, reduce debt from $36 trillion to $34 trillion. Buy 5 years of creditor confidence. This is territorial concession via asset sales. The Ottoman Empire did this from 1878 to 1920. Shia lost Egypt in 1882 when Britain took control to secure Suez Canal revenues for bondholders. Lost Libya in 1912, sold to Italy for debt relief. Lost the Balkans piece by piece as European powers carved off provinces in exchange for debt forgiveness. By 1923, the empire controlled only Anatolia, 17% of its 1800 territory. Here's what this means for you. When the government sells the Strategic Petroleum Reserve, gas prices spike. The reserve stabilizes supply during crises. Without it, every Middle East disruption sends prices up 30%. When port concessions go to foreign operators, they control choke points. China operating Long Beach means they control West Coast import flows. When federal land gets sold, mineral rights, timber rights, water rights, all transfer to foreign buyers. Those are strategic resources that should benefit citizens. Instead, they generate revenue for creditors. The second-order effect is sovereignty erosion. When foreign entities own critical infrastructure, they have veto power. If Saudi Arabia owns Texas oil fields, can the U.S. sanction Saudi Arabia? If China operates California ports, can the U.S. block Chinese imports? The Ottoman Empire learned this. When European creditors controlled railways, ports, and mines, they dictated economic policy. That's not sovereignty. That's a client state. Bottom line, asset sales are irreversible. Once sold, you can't buy them back. Britain sold off state industries in the 1980s under Thatcher. Privatization raised £60 billion, but those assets now generate profits for shareholders, not the state. When the next crisis hits, the government has fewer assets to liquidate. Selling long-term strategic assets to fund short-term debt payments doesn't solve the problem. It accelerates the decline. And here's where it gets worse. The buyers aren't passive investors. China's Belt and Road Initiative lends to developing nations, waits for default, then seizes ports and infrastructure as collateral. Sri Lanka's Hambantota port, Pakistan's Gwadar port. The model is simple. Loan money you know can't be repaid, then take the asset. You might be thinking, the government wouldn't sell strategic assets. It's too dangerous. Here's the problem. When insolvency arrives, you don't have options. The Ottoman Empire didn't want to lose Egypt, but British creditors demanded control of Suez Canal revenues as debt collateral. The empire resisted. Britain invaded, occupied Egypt, and seized the revenues anyway. The choice was, sell voluntarily and get some value, or lose it through force and get nothing. The U.S. will face the same calculation. Sell assets in an orderly process, or face creditor-coordinated infrastructure seizures through legal mechanisms. The Treaty of Sèvres in 1920 was exactly this, a creditor-imposed liquidation plan. We've completed 5 of 7 stages. The pattern says Stage 6, territorial concessions, begins when restructuring fails. Same city, same ministry, different ledger. The question was never whether America would face an Ottoman liquidation. The question was whether anyone would notice the terms had already changed before the auction screen showed no bids. The $7.2 trillion vendor financing position isn't a financial relationship. It's a closing contract. And Stage 6, loss of geopolitical control zones, begins the moment creditors realize the collateral, your bases, your resources, your infrastructure, is worth more than the promise to repay.